welcome back to the channel. I am so glad you're here today because we're going to talk about something that confuses a lot of people. Hard money loans. Now, don't let the name scare you. I'll break it down in a way that actually makes sense, and by the end of this video, you'll feel like a mini expert. So grab your coffee, your notebook, or your dog, and let's dive in. So, what is hard money? Unlike traditional conventional bank loans, a hard money loan is based on the value of the property being used as collateral, not just your financial position.
What am I gonna do with all this money?
And to be completely honest with you, I do not like the term hard money. It just sounds intense. I like to call these loans bridge loans because that's what they are. They're short-term loans, typically 6 to 18 months, and they're interest only. Hard money loans can be very attractive for real estate investors because they tend to close much faster and offer more flexible terms. That means you can pay them off quickly and they allow you to scale your business way faster. Yes, hard money loans tend to have higher rates, but they give you access to quick capital and a fast turn time. A lender can give you up to 90% loan to value, which means 90% of the cost of the property plus 100% of the renovation budget. Now, although a traditional bank loan might have lower interest rates, it usually takes 30 to 45 days to close. That is not ideal for an investor who wants to do a fix and flip. Investors usually buy homes that are distressed properties that sellers want to get rid of fast. For that, you need a fast closing. Also, traditional banks don't lend to own a distressed property if it's not livable. You need to do an FHA construction loan or a conventional loan, and if the property isn't owner-occupied, it becomes even more complicated. You'd have to abide by completely different guidelines.
Money makes the world go round.
So, let me explain to you how hard money works. Like I said, the lender will first evaluate the asset, meaning the property. They look at the purchase price, the cost of the rehab, and the ARV, that's the after repair value. Other factors they look at include the area, how fast the property sells in that area. Lenders are not very fond of rural areas. When they do lend in rural locations, they usually ask for more leverage, and that's where the investors they have to put more money down. And let me tell you, lenders are always looking at risk. Believe me, no lender wants you to default on the loan. They want to make sure you're able to pay it back. They do not want to keep the property. That would be a huge headache for them, and nobody wants that. As of right now, interest rates for hard money loans can range from 9.5% up to 12% depending on the lender, the area, and your experience. Another thing to consider is origination points. These are the fees charged by the lender and the broker. They can vary, but we typically see around 4%. The good news is that origination points are tax deductible. What I love about these programs is that there are no prepayment penalties. You can buy a house with as little as 10% down, receive 100% of the rehab costs, and sell it in 2 months if you're fast. And you've only paid interest for 2 months.
Count my dollar bills.
I'll be posting another video soon to show you exactly how we calculate these transactions and how to run the numbers for a fix and flip. Okay, now let's talk credit. Lenders do look at your credit, but your credit score and your debt don't play a huge role. What they're really looking at is your behavior when it comes to paying your debts. They will have an issue if you have a multiple 30-day late or a foreclosure. And don't get me wrong, there are lenders, especially local lenders, who won't even verify your credit. They know the market very well and base their transaction entirely on the asset. These lenders can be more expensive and may require a larger down payment. Another thing lenders look at is your experience as an investor. When we talk about experience, it needs to be apples to apples, right? For example, if you're applying for a fix and flip loan for a property that costs $200,000 and requires $100,000 in construction, the experience that counts will be from similar types of projects. Now let's talk about leverage. Typically, the down payment required to purchase a fix and flip property can range from 10% to 30%. Investors who can put only 10% down usually have at least 3 completed flips with a successful exit within the past 3 years. By exit, I mean you bought the property, you fixed it, and either sold it or refinanced it with a long-term loan. If you're a new investor, expect to put around 30% down. Every lender has their own guidelines. They adjust their terms based on several factors like experience, property location, credit, and even citizenship status. Now, I get a lot of questions from new investors who are worried about interest and origination points. Here is my honest take. Those numbers should not be the biggest concern, especially if you're working with someone you trust and who's effective. Getting your deal done and done right, that is what matters.
Done deal, put that on my mama.
And don't forget, interest and origination points are tax deductible in investment properties. They're capitalized as part of your cost basis, just like your rehab costs, closing costs, and other acquisition-related expenses. When you sell, all of these costs are factored into your total cost basis to calculate your capital gains or your losses. And here is an example. You buy a property for $100,000. You pay $4,000 in origination, $10,000 in interest, $2,000 in closing costs, and $40,000 in rehab. That makes your cost basis $156,000. If you sell the property for $200,000, your gain is $44,000 before any deductions. That means the IRS will only tax you on the capital gains. Everything else is totally deductible. And yes, you might pay 4% in origination, but that same amount can be taxed at 10% to 37% by the IRS. It's all part of doing smart business. Now, how you find a hard money lender? There are tons of national hard money lenders and also lots of local ones. The advantage of working with the local lender is that they know their market really well and they don't look at your credit. The downside, they might be a little bit more expensive. The best way to find a lender is to hire a broker. Brokers typically work with hundreds of lenders and they can find the best fit for you. What about appraisals? That depends on the lender. Some only do a BPO, which is a broker price opinion, or drive-by evaluation. Most still require full appraisal, and these appraisals are usually quick, often just a few days. Let's talk about the letter of intent. This is a preliminary document from the lender outlining the terms and conditions, but it's not a loan commitment. It's similar to a loan estimate on a conventional loan. It will include the loan amount, interest rate, loan terms, collateral details, funding conditions, and fees. But remember, it's based on the preliminary info you submitted. These loans aren't officially underwritten until the appraisal or BPO is in. Only once the appraisal is back will your loan terms be final. So please be prepared. Loan terms can change. If the IRV comes in higher, great. Your terms might improve. If it comes in lower, you might need a larger down payment. Sometimes I tell borrowers to walk away from deals if the numbers don't work. I'd rather lose a deal than set someone up for failure. So make sure you're working with a broker who's in it for the long haul, not just looking to close one loan and then move on. All right, quick recap. Hard money loans are short-term asset-based loans. They're great for investors who need fast closings. They offer high leverage up to 90% LTV and 100% rehab. They're interest only with no prepayment penalties. Costs like interest and originations are tax deductible. Credit matters less than your behavior and experience. And loan terms aren't final until the appraisal is in. I hope this gave you a full, clear picture of what hard money is and how it works. If this was helpful, don't forget to like the video, drop a comment below with your questions, and subscribe to the channel. And be sure to watch the next video where I'll be showing exactly how we calculate a fix and flip deal, step by step. Thank you for watching, and I'll see you in the next one.